Quick question. If I told you there's an investment that pays you consistently, doesn't give you heart attack like crypto, and doesn't wake you up at 3 a.m. checking prices, would you believe me? No, it's not juju. It's called bonds. And today I'm breaking it down so simply that even your WhatsApp group admin will understand it. And if you think bonds are only for rich people in suits, stay till the end. You're about to be pleasantly shocked. Let's start from ground zero. A bond is basically an I owe you. You give money to a government or a company. They say, thank you very much. I will pay you interest every now and then and return your full money later. That's a bond. When a bond is created, it comes with a face value. Think of face value like the original price tag. For example, 1,000 naira equals 1 unit of a bond, or $1,000 equals 1 unit of a bond. Sometimes 100 naira equals 1 unit, depending on the bond. What you're buying is not vibes. You're buying units. Now let's talk about where bonds are first sold. This place is called the primary market. Primary market means you're buying the bond directly from the government or company, fresh out of the oven. Think of it like this. The bond issuer is the manufacturer. They sell in bulk to wholesalers. The problem? The minimum buy-in is usually high. So you hear things like, minimum investment 50 million naira. And you're like, I just wanted to test the waters, not swim the Atlantic. Good news. Relax. Breathe. This is where the secondary market enters. The secondary market is where people who bought bonds earlier say, you know what? I want my money back before maturity. So they resell. If primary market is the factory, secondary market is the retail shop. This is where most people with small money invest in bonds. Now here's where things get interesting. In the secondary market, bond prices don't stay the same. Sometimes the bond sells above its face value. That's called buying at a premium. Other times it sells below face value. That's called buying at a discount or below par. But here's the plot twist. No matter what price you buy it, if you hold the bond till maturity, the issuer pays you back the face value. Yes, not vibes, not feelings, face value. Now I know what you're thinking. Why would I buy at a premium when another bond is cheaper? Calm down. Don't fight the bond yet. Bond prices move like weather because of things like interest rates, market conditions, demand and supply. Most times, bonds selling at a premium have higher interest payments. Bonds at a discount usually pay lower interest. Does that mean one is better than the other? No. It all depends on your financial plan. There's also something called yield to maturity. Big grammar, simple meaning. It simply means, if I buy this bond now and hold it to the end, how much will I really earn? Smart investors always check this before buying. Yes, bonds are fixed income. They pay interest regularly, usually twice a year. If you pay school fees in January and travel in July, you can buy a bond that pays January, July, school fees, covered. Vacation, covered. You can even split your money into 2 different bonds. So you receive cash every 3 months. That's called planning, not luck. One more thing most people don't tell you. If your bond price goes up significantly, you don't have to wait till maturity. You can sell it, make profit from the price increase, reinvest in another bond or another investment. Yes, bonds can pay you in interest and capital gains. So no, bonds are not boring. They're just misunderstood. If you like steady income, predictable cash flow, and sleeping well at night, bonds deserve a seat in your portfolio. If this video helped you understand bonds better, like the video, subscribe for more simple money lessons, and share this with someone who still thinks bonds are only for rich people in suits. See you in the next one. Stay smart. Stay paid.